Hey everybody, I believe I have some latency again here. I hope that's not the case. Thanks for joining us before the close. We set this up this morning thinking that maybe there'd be a little bit of volatility or the possibility of volatility into the close today. And as you can kind of see on our bookmap chart here, market's been holding up pretty well. We did test what our zero gamma level is, but there's just such a big position at 4,000 that the opportunity for volatility today just really wasn't in the cards, right? We had to kind of wear away some of that gamma at 4,000 in order for things to really break lower. So you can see that not only did the market not pull away from the big 4,000 level, but if you look at this intraday hero indicator, which is the real-time options flow on the day, this is all positive delta flow. So this meant likely that guys were selling puts all day long. You can see that the VIX really drifted much lower, and as the market kind of just drifted sideways, those puts are all getting smashed, right? Anyone who's kind of been hedging the last few days, hedged yesterday, was concerned about the market this morning, you know, all those guys just got squashed. All that vol gets crushed. As I mentioned in the morning note, there's a bunch of put positions at the 4,000 strike that are likely rolling off today. Those are all going to get crushed. So, you know, this is kind of just the same thing we've seen for the last several weeks, right? Anytime vol pops a little bit, it just gets absolutely smoked. And so what you can see this morning really is the market is weak, right? The futures were quite weak. They were below our volatility triggered level. But once the US market started to open, there's just this rush to cover all of your puts, right? There's this rush to get out of whatever position you were in for downside protection. Those positions all get smashed, and then we kind of consolidate back into this big high gamma area, right? And anytime we try to pull away from that, we sort of stick. So what's interesting here is we have about 30% of SPY gamma rolling off today, and only about 8% of SPX. So we'll get a little bit of movement next week, I think, particularly on Monday, right? Either we got to have some vol smash and the market's going to ratchet up to the next level, which I think is 44.50, or we're going to start to drift lower. Now, one of the things I want to talk about is how this market's sort of hedged, right? And the fact that vol crush, that's funny. I did just call you vol crush. What we want to show you is why we think the market's just pretty well hedged into the FOMC Jackson Hole event in September. So let's flip to a couple charts to take a few look at things. So first of all, I wanted to just show, we put this in our subscriber note again last night. The large 4,400 area has been in place for several days, over about a week now. So that's what this big red line is. And once you feed into that line, it's like a magnet, right? I always think of this concept of like a UFO hovering above somebody, and it's like a tractor beam, and it just kind of like pulls you in, you know? And that's kind of what this level is. What's funny is everyone hedges the FOMC event, right? And if you just sort of look at this without dates, you know, could you pick out the FOMC date? Well, I mean, the FOMC date is actually right here. It's like it's the least volatile session that there is, which is kind of funny. So again, you just kind of get this feedback mechanism into the 4,000 strike, the 4,400 strike, because there's so much gamma there. And unless you have calls build up overhead, gamma build up overhead, and we can shift the options range, then this is kind of the same story, right? We're just going to pin this big area. We also note that 440 in spiders is, you know, the really big level there. So, you know, we're just kind of stuck in this 440 in spiders is roughly 44.10, something like that in S&P. So we're just jammed up really in that area. So one of the things that we found really interesting is what we call the intraday volatility. We call it compression, but if you flip over to this chart here, when you look at oftentimes realized volatility, what we're looking at is close to close volatility. So that's what you see here. And close to close volatility is actually showing on I believe this is a 5-day basis, near lows, right? But there's been some pretty wild swings, particularly in ES in the futures. But, you know, really, if you look at the intraday vol after the options expiration, we've been having some pretty wide swings. So the VIX is at like an 18 right now, but the intraday movement of markets has been pretty high. This is a high, the reading above green here is a high intraday, high low on the day, right? So that's the intraday vol. Now what we believe is that because when you have large positive gamma and dealers are hedging, that as we get into large gamma areas in the market like 4,400, the intraday movement, right? This could be high, the high of the day to the low of the day that range could be very large, right? But you would still see a very tight realized day-to-day vol, right? Close-to-close vol. So in other words, what I'm saying is if we have high gamma, we can have a very large range on the day, but the market making positive gamma hedging flow would sort of conceal that intraday volatility, right? Because they're going to push the market back into these gamma zones. So in other words, this is very tight, right? This is pretty tight realized volatility compared to fairly large swings in the high-low range on the day. And that to us is showing the power of the gamma trade, right? The buy the low and sell the high and push the market into a tight closing range, even though we can have wider intraday swings. And so I think this sort of is more evidence of when we move into these high gamma zones that the market just pins, even if we slowly push off of the big gamma level like we did today. We pushed down off of this level today, and then we snap right back up, right? I mean, this is now we snapped high, we come right back. We push low, we come right back. This is that pinning trade that we would expect. So that is prototypical behavior. And with all the China fear, FOMC might taper, inflation, GDP, all the weird stats that came out, right? We still get the same thing. And that's because you have such large gamma that unless there's some kind of conviction for the market to push it out of the grass, so to speak, of the market maker hedging flow or cause dealers to shift hedging, then we're just going to keep getting this pinning behavior, right? The market needs to push the market makers out of their hedging pattern in order to sort of elicit a different response, kind of shift markets away from what we expect. One other thing that we want to talk about in regards to the volatility structure and the way that volatility is moving is obviously that FOMC, the Jackson Hole meeting that's coming up in September. So if you look at this, is a great chart. Many of you know probably VIX Central, and this kind of plays into some of the things we're talking about now. There's this interesting dynamic in the market right now. This is going to tie into sort of how well the market's hedged. And we're going to show you a chart on that in a second. But this is the vol structure, the VIX structure for the futures, and this is where the VIX index is trading, right? It's trading at 18. The VIX futures are way up at 20. So there's a very steep contango here. And this contango probably doesn't go away because of the fact that all of these futures are pricing in the Jackson Hole, and many of them are pricing in the September FOMC rate meeting, right? So there's that event risk or that volatility premium for that event risk that these futures are all holding, and the VIX is quite a bit lower, even though it's at 18, it's quite a bit lower. So there's this big contango, and if you look at the SPX or SPY options market, you get a similar thing if you start to look at the price of, some puts, particularly even 3 or 5% down in August, and you compare those to the September SPX or SPY puts, and you can see that difference, right? There's this very sharp contango. So while there is not much volatility hedging for August, there is a bunch for September, and a market that is well hedged is a little bit harder to sort of spark a sell-off. Those positions are in place, particularly the quarterly SPX options positions that are in place are usually by big institutions who are not going to actively trade those, right? They have those hedges on for the third quarter, and they are likely not to trade those or have those roll off until expiration. If you think back to the March COVID crash last year, the market bottomed, as many of you know, you've heard me talk about this before, the third week of March, which is when options expire. All those big put positions that big institutions had on expired, and then the market bottomed on the next Monday. So we did get some kind of sell-off. We think that that's an important day to highlight, right? Circle that on your calendar, as if we do get kind of like late August or early September selling, highlight that third Friday of September as a possible bounce area or bounce location. Now, with this downside hedging, we want to show you a picture of the Equity Hub, which has been a really fantastic tool for timing bottoms, and we kind of want to talk to you about and show you this as to why we think the market's pretty well hedged. So when you look at the Equity Hub charts, what this is showing you is the rate of change of gamma. So they call that speed. But basically what we believe this is mapping out is when you have a lot of change in gamma, that's going to elicit hedging responses from dealers and market makers. So we obviously have a lot of gamma concentrated around at the money right now, right around the 4,400 to 4,425 area. And you can see that there's a big drop in that gamma down to 43.30. So many of you who are subscribers know that we've been talking about this 43.30 as an inflection point, and that's because you can see that the change of gamma, the rate of change of gamma, I should say, really halts or hits this inflection point right at 43.35. In the past, these inflection points have shown as great places to bet on the market bottoming. Obviously, there's no guarantee in any of this, but we've seen time and again that the market will pause at these positions wherein gamma changes or has a significant change. So the gamma builds back into 42.80, 42.75, and what this is telling you is that there are large positions in the 42.75 area. Right, there's large put positions in this area. So basically, we have this channel, so to speak, where there's not much put positions in this immediate 43 to 43.50 area, but down below into 42.75, that the put positions pick up. Right, the market's well hedged, and then obviously there's this kind of chasm really down into 4,000. 4,000 has a ton of options positions. So if you're going to kind of bet on a big sell-off, big picture sell-off, we think 4,000 would be probably a bottom, not only because of the huge put positions, but people are focused on big round numbers, as many of you know. So in a real kind of catastrophic drawdown scenario, which we're sounding all doom and gloom here, but the fact of the matter is that there are just a lot of put positions here, right? This chart, the fact that there's just not a big V down here, and that there is this big put position, is telling us that the market has some pretty good hedges on, and that is likely to kind of hold things up. Now, if traders were suddenly spooked and added a bunch of hedges, right, that could elicit a lot of dealer selling, dealer shorting, and that could really spike volatility. But the fact is that because there's so many hedges on, if you do get some drawdown in the market, those hedges can just be rolled off, and that can help provide some bounce material, right, some fuel for a bounce in markets, which is tied into that sort of reflexive volatility selling that we often see. So, these positions down here again are telling us that the market is really pretty well hedged, and it would take a lot of hedging and a big change in the way things are positioned, right? The addition of a lot more puts to really get a fair response, a big drawdown, right? So it's not only these put positions, but obviously just the reflexive behavior, people to sell vol as soon as it spikes. So, those two things we think are really just limiting the downside, and it will probably take some kind of major credit event to move markets enough or to cause enough selling to overwhelm this positioning here. So I'm going to touch on a few questions in a second. One thing I want to talk about is Amazon, because it is having such a rough day today. If you look at Amazon, obviously they had the earnings, which we're not going to comment on the earnings plays here. But if we kind of zoom back, and this is showing the hero indicator, the flow obviously in Amazon today, turn off some of these on-screen indicators, and then we'll take some questions right after this. I'll be quick because I know many of you need to trade the close, so let's turn off some of these delta icons. So, this is the flow in the market today for Amazon. It's been very bearish flow. I was thinking today we may see some bullish flow, people trying to sell put spreads or maybe play a bounce in the fangs. I mean, everybody has been dying for an opportunity to buy dips in any of these market leaders, and today obviously we're not seeing that step up. So that flow has obviously turned sharply bearish since about midday, and you can see that the stock is really following along with that. Now, what's interesting about this position here, if we flip to the equity hub, I think we may get a bounce in Amazon for next week, and that is driven by some put positioning. So let's just take a look at this. I'll give you the quick rundown on why I think that is. So if you look at the current options position, 40% of gamma is expiring in Amazon today at the close. So these were all likely earning trades, people who piled on to the selling today. And what you notice here is that the largest put position is at 3,500. So that's where the most put open interest is in Amazon. Now, I do not believe these to be longer dated puts. I think the bulk of these are going to expire today at the close. So what's interesting about that then is if you think about all of these puts being in the money, right, that the delta hedging is going to be tied to these in the money puts. So weakness in the name, there's pressure in the name because of these in the money puts. And once these puts get wiped out, we may see a lift in the stock as a response to all of those puts expiring. So you can see here, this is the 3,500 strike. It is very big. There's a bunch of our levels here, and we think that this dynamic, I mean, the stock is way down here. We think that this dynamic is going to change and get wiped out. And that could elicit a buyback, right, in short hedges based on the fact that a lot of these 3,500 puts are likely to get wiped out. Now, if you do a quick look at an options montage for options expiring today in Amazon, you can see how big that position is. But I think it's an interesting point to get a relief rally of some point, right? I don't have a fundamental view in Amazon, so I have nothing to offer you other than the fact that I think that the options, because it's such a large position, because those positions are now so far in the money, that those are keeping pressure on the stock. And as those put options expire, I mean, this is all put, you know, the fact that this is all red, right, and the stock drops so much is telling us put options are in control of this name. The dark blue line is telling us that the options activity is very heavy yesterday. Obviously, it's going to be very heavy today. And so this is kind of lining up, we think, to be a nice sort of pot maybe in the stock yesterday for next week, excuse me. So something to consider here as we watch a bellwether of the market. So that's the quick rundown. You know, again, we were thinking that we were going to get some pretty sharp selling, or the opportunity was there for some sharp selling because the market was opening so near this volatility trigger level. That didn't kind of manifest. We're just kind of holding up the pin. And so I'll spend another 5 or 10 minutes taking some questions here, and then we will let you guys go to trade into the close. Hey, Paul. Hey, Miles. Let's see here. Thoughts on open interest in GME. So I would just say in general in these FANG stocks, I have a real issue with a lot of these FANG stocks because, you know, there's these idea of the retail community fighting this battle, right, against hedge funds and short sellers and the like. And I think that the battle is retail fighting themselves. I mean, everybody I talk to, you know, I worked at a bank, several banks for 20 years. I have a lot of contacts in various different entities on various different desks at investment banks, and nobody can corroborate any of this, you know, information, right? And these are guys that don't have an axe to grind, right? They are not market makers. They are not necessarily, you know, hedge fund guys. They're, you know, guys that work on algo desks, guys that work on short loan desks, you know, things like that. There's no evidence that we have that suggests that there's this, you know, bond melting, short selling conspiracy. I think that pretty much the hedge fund public just doesn't care about this name anymore, right? Why short it? The risk is too high. Prime brokers are not going to be happy with you for shorting these meme stocks. And then not only that, we've shown in several videos that AMC just pins its large gamma areas. GameStop did the same thing. That's just pure market making hedging, pure market making flow. The implied vol in these names is very high, very expensive. I think that drains out a lot of the retail public. I will say in AMC, I think that the float is very low. So if you can somehow spark another, you know, a piece of news, or maybe you get some short-term momentum in the name because the float is low, the tradable float. But as far as there being this conspiracy that's going to, you know, have an infinity squeeze, I'm totally lost in respect to that. None of that really makes any sense to me. So I think it's smart to look at where these big gamma strikes are. So example 40, these are likely calls. And if you look at GME, it's the same thing, right? And as long as the stock breaches these key gamma levels, I personally want to be short that name, right? And a lot of times you'll get Monday and Tuesday, just like what I was talking about, these pops in the stock where people pile into calls on Monday and Tuesday, and then those calls lose value and the thing fades. And that happens week after week after week after week. The call volumes and put volumes and stock volumes in these meme stocks are not what they were. Yes, they can have these flare-ups, but you know, I think in general the professional investing public is just not all that active in these names. And AMC and in particular, and you have this big, you know, retail mafia that thinks that there's this conspiracy and they're fighting this war, and I just don't think that I don't think there's anyone else on the battlefield, right? I think they showed up with their weapons and they're standing in a field by themselves, all upset. Spurious, good point on the volatility trigger. So the key with the volatility trigger is many people talk about zero gamma and that being a flip line. Well, if you think about zero gamma, we talk about this all the time. Zero gamma technically means that market makers have no hedging to do, right? Zero gamma means they don't have a hedge. There's no gamma to hedge. So that line never made sense to me as the place to watch for a real flip. Our model picks up this volatility trigger as the last line of defense. If the market breaks this level, right, there's an inflection point there, in which point dealers will start to sell on the other side of that, right? So it's not that the dealers are kind of neutral and don't care. Our volatility trigger, if you break that, that means that they need to sell on the other side of that. So think about it as like almost like a stop order, right? Their stop gets filled, the vol triggers their stop. If that gets filled, then look out below, right? There's no more support there, and that's really what this vol trigger is. And it's kind of interesting, we're getting a little bit of pressure now in futures. Don't think that really manifests in anything unless people are concerned really about the close here. Hero coming to toss. So good question, Maze. I can tell you that as far as the Thinkorswim platform itself, it won't be there. We are looking to launch Hero on SpotGamma.com. I'm hoping in the next 4 weeks. My partner Matt is likely on the channel here. He's probably going to yell at me about saying hopefully 4 weeks, but no promises there. But that is where you'll see it first on SpotGamma.com. Our goal is to have it show up on the real-time charts, something like that here, where you can see the Hero indicator show up on the real-time dashboard. Hey Paul, thank you very much for all your comments. I appreciate those. I'm glad to know it's working out for you. The Hero indicator is working out for you. That's right, Maze. VIX smash here. Meduna, I appreciate that, buddy. Right, Maze, the Jackson Hole vol crush. And time is not a bear's friend. You know, Letzer, I apologize, I probably mispronounced your name there, but that's really right. I mean, I have this analogy, right, that I talk about all the time about, you guys maybe have heard this analogy before of if a shark stops swimming, like it sinks. And that's called ram ventilation, in case you're curious. And the idea is really kind of the same in markets, right? If you think about volatility in the VIX. When the VIX is this elevated, right, if the market just trends sideways, the VIX is going to drop because implied volatility is like energy. And so if the market stops moving, particularly if it stops moving down, then that energy just kind of like falls apart, right? Just zaps out, and the volatility is going to sink. And so you can see that happen today with the way that these markets traded. You know, if you look at particularly like VXX, which is like the leveraged aspect of volatility, you could just see that, you know, it just gets slammed, right? Because the market, that vol is heavy, the VIX is high, right? And if it doesn't get that movement, right, if that energy isn't there to support that higher VIX, you just get that reflexive drop so fast. That's the vol is so high right now. And, you know, with that, we're going to have a sell-off at some point, right? And of course, the famous thing, like, when do you actually get the sell-off? Well, the fact of the matter is we don't know, right? If the market crosses the vol trigger, then I prefer to be short. That's me personally on that initial cross. That is my risk warning. It doesn't matter if it's Chinese credit or Tether blows up or whatever it may be. You know, once that vol trigger gets crushed, I believe that I have an edge because dealers should start shorting. So that is when, you know, we think we get the sell-off. And if we actually get a sustained sell-off, you know, credit markets maybe start to bleed a little bit. You know, I think this time we'll see a VIX 100, right, on the next major, you know, 4 or 5% drawdown. It's been a very long time since it had that kind of drawdown. At some point in the future, we'll have it again. Could be 2 months, could be 6 months, could be 2 years. I mean, I don't know, right? But we just trade sort of the way that the market's positioned and let the options sort of show us that edge. But I think because the vol is so high, because there's so much kind of leverage, and I think the liquidity in the market's not that great, that we'll see the next big spike will be, you know, I think a real record here. So. Hero and Jigsaw, LS, you know, basically what we're doing with Hero and our partners at Bookmap is we have the infrastructure up to build an API, and we are aggressively going out looking for partners who want to connect into that API. That API program is being tested actively right now. I think in a couple weeks it'll be ready, and hopefully by the end of the year we're just going to be, you know, knocking off different platforms that want to connect into that API, including for those of you who have interest, you may be able to connect that API yourself. That is something we're considering. If you have interest in that, shoot us an email, let us know, so we can kind of put you on a list and keep you all updated on that. Gypsy Blood is asking if I have any opinions about Fitch. I don't. That's not a name that I cover. Let's just see if it has a big options position. It's a very small options position there, Gypsy Blood. So you see just not many calls trading, very low volume. So I don't have much to offer there because that options volume is so low and so small. Incidentally, if you look at our charts and you see how you can't see anything on this chart, there's no red or green area, that's telling you that there's no options position, right? If it's a deep dark color, there's a big options position relative to the amount of volume trading in the name. So that just visually tells you, oh, options matter. You can look at this chart, see nothing here, then you know that options don't really matter in that name. Yeah, so in buying VIX puts in September and August, that's a good point. I think I kind of left that off there. You know, it's interesting. calendar spreads maybe where you're looking at shorting August vol and buying SEP, the SEP vol should hold up better, right? So if you did think a market was going to crash the next few days, it makes more sense to buy SEP vol than August, arguably, because if you're wrong, right, there's going to be less decay and the position in SEP will hold up a little bit better because it has that event vol in there. So that's just something to consider as you all look at that. Jim, I did not see the Brazilian hedge fund show up on in GameStop. I did not see that. It's not something I typically watch, but we can look at the GameStop position here. The volume in GameStop is just fading. I mean, this thing was trading several 100,000 contracts up into the millions every day. Now we kind of just trade, 10, 20,000. The open interest is very, very small. It's put heavy. There's just not. To us, it's just not all that interesting of a name from an options perspective anymore. It doesn't mean that there's not some interesting trades outside of that. But from what I see, and maybe this Brazilian hedge fund trade will show up, on Monday and make it interesting again. But for me, it's just kind of, I don't want to say dead money. It's just kind of lifeless, right? There's not much vol there, and I kind of like to look where the vol is. Prithvi, I can't recommend if you buy or sell puts on Monday. Not much to offer you there. And then I think we'll look at Tesla and we'll probably close this one out as we're kind of getting right on the bell here. Appreciate everyone on Friday night, under the close. So 700 in Tesla is the big number. What's interesting about that is a lot of these deltas, and the key delta strike is 600, still remain out in January. So that 600 number is a number that probably doesn't go away before then. Huge call volume, and a pretty good chunk of this will expire of the 700. So 700, is the big number, and we're kind of up near that level into this expiration. This name is a name that respects these options levels, right? It trades into these big gamma strikes constantly. 600 and 700 numbers that come up all the time. This is always interesting, I think, to trade butterfly trades, call flies, put flies, things like that into these big numbers on the weeklies. There's generally some pretty interesting trades to take. I mean, you can see that here we kind of charged into 700 and then it backs off a little bit, but Tesla respects these big gamma levels. So next week with 34% expiring today, next week these numbers probably change a little bit, but 600 to 700. I mean, now that Tesla's in the S&P 500, it's a lower volatility name. You kind of don't get the same movement that you used to, and so I think you get you can play these pins a little bit better than you used to. So, LS, the OCC chart we can talk about quickly. Good point, Eugene, on the gamma strike moving up. So one thing, and we're building in a scanner for this. One thing that I love to watch for bullish movement is when the key gamma strike shifts up and there's a lot of open interest. So you can see that volume was pretty big yesterday at 1.1 million contracts, and the key gamma strike rises. That's always a bullish move in my mind, right? This key gamma strike going up is telling me that the center of options hedging is moving higher. It's the same thing with the call wall and the SPX moving higher, right? It's the same idea. The center of hedging moves up, and that's where the flow is going to go, right? I always kind of make that little rhyme joke where the options are, the flow goes, right? And so, you can see that build up. That's a great eye, Eugene, to pick that up. We're actually building a scanner, so you'll be able to come up here and click on a bullish scanner that's going to pick up all the names that show key gamma strike moving up with volumes moving up as a nice way to find some bullish names to play. Yeah, so Cedrona, I'm also going to be putting together a video, an in-depth video on Equity Hub. We've made so many advances and changes to that, so I'll make sure to cover the change in 5-day trend there. We'll cover some of these new aspects. We'll cover this new sandbox feature and different things like that. So we're going to leave it there because we are right on the bell here. Appreciate everybody's time. And if you have any questions, put them in the comment section and we'll make sure to respond to those. We're going to be adding some new videos to address some of the changes, some of the new features we have. One of the other things to note is we have this new OCC page, which will be publicly available for this week. We've made some changes to that, so there's some exciting new views. That data updates every single Saturday. That's when the OCC data is released, so look for some cool new features in there. I post these charts often. They have some really neat longer term kind of week to week data in there. So we've made a couple of enhancements just to this page. So you'll definitely want to check that out. You can see it's OCC premium and contacts. I'll put that in the show, in the episode notes there below. So anyways, we will leave it at that. Thank you guys for all showing up on Friday night at the close. Hopefully this made your Friday close a little more exciting. Enjoy the weekend. Again, any comments, please put them in the section below, and we will be sure to respond. So enjoy the rest of your weekend, or enjoy the start of your weekend, I should say. Bye.